And that decline in the dollar has investors outside the U.S. buying up companies in the S&P 500. Dollar weakness as stocks trading at some of the lowest valuations on record. My next guest has been adding to his international exposure for that reason. Gayle is a senior investment strategist and director of asset allocation at Ridgeworth Capital Management with $60 billion in assets under management. Joining us now from Richmond, Virginia. Welcome.
Thank you very much for having me.
First, set the stage for us. Give us your dollar forecast.
Well, we have been looking for the dollar to remain under, I would say, orderly pressure as we finish up this year and go into 2010. Some of the comments that were just made about the issues or the factors that are likely to push the dollar lower as we finish up this year and go into next are likely to continue. And we just, so we have been adding to our international exposure, both in the developed and especially in the emerging markets.
So how specifically have you been doing that? Can you talk industry-specific names that are really benefiting overseas from our weak dollar?
Well, I would say that what we have been doing in the allocation strategies, again, is increasing exposure broadly in the international front and, again, in the emerging markets. We've also been focusing even in the domestic large cap funds. We've been focusing on names that are likely to benefit from what we think is going to be faster growth outside of the U.S. So whether that be technology or some other names, say in the energy space or the materials space, we think all of these are likely to participate in what we think is going to be stronger growth outside the U.S. than domestically.
And this strategy, does it correspond with your timing for what your outlook for the dollar is, say for when the Fed becomes hawkish and begins raising interest rates?
Well, we think that the Federal Reserve at some point is going to begin raising interest rates, but that'll probably be next spring at the earliest. At that point, my guess is that the U.S. Fed is probably, or the U.S. Central Bank is likely to start raising rates on the early side, and so we might see some dollar stability and strength as we move into the second half of next year. But that's something that we're going to continue to monitor.
So meantime, European investors are taking advantage of some of the cheapest S&P valuations on record. So does that pose any kind of competitive threat to your strategy, or how do you consider it?
Well, we're looking at, clearly U.S. stocks have gotten cheaper over the last 6 to 9 months, and there's no question about that. One of the things that investors have learned is that cheap is not necessarily a catalyst. So we continue to focus on companies that are part of the growth story. So I think when by doing that, we still see good opportunities overseas, again, in the emerging markets. And even domestically, we're focusing on those companies that are actively involved in the growth story.
Yeah, top line right now, a big challenge for U.S. companies. Do you think overseas companies are having an easier time building revenue?
Well, I think that we're seeing obviously the best performance is coming in the developed emerging market countries like the BRIC nations. Those are the ones who have been at the forefront. We think they're going to remain at the forefront. We are a little concerned about the EU. We are concerned about Japan and their ability to generate strong top-line growth. So it's not a uniform let's own international, but clearly there are more opportunities, we think, outside the U.S. than inside.
Can you talk more in detail? I know you referenced asset allocation earlier, but what should that pie look like in terms of international versus domestic right now, and even work fixed income and cash into that metric?
Well, I would say that more generally across our allocation strategy funds, we are what I would call moderately overweight the international space. And so the question is going to be what your comfort level of international exposure is going to be. You know, from a global standpoint, you should be 50-50. If you're not comfortable with that, then clearly you should be on the upper edge of your exposure. We are moderately overweight equities as well. We began adding in late March to our equity exposure, and so we're underweight bonds within the bond space. We like high yield. We've been maintaining exposure to high-grade corporate credit as well.
What would cause you to alter your strategy? Something in the U.S. economy, like let's say job growth picks up unexpectedly?
Well, I think that fundamentally what is driving the strategy is that we think the economy is stabilizing and starting to turn up. We are not We do not have an overly rosy scenario. We think that growth from here is going to be below average from a trajectory standpoint. But if we find a situation where companies discover that they have not done enough on the cost-cutting front, if we go into probably what I would call a phase 2 of job cutting, then clearly it would be time to take a serious look at how strong the economy can grow in 2010. But right now, we don't think that's likely.